This might change your opinion about the future of stock market returns. Now, I don't know. I have no idea. You don't know. I'm not God. I don't know what's going to happen. But we're going to look at this a little bit here because I think it's very, very interesting. So this is from the NBER, National Bureau of Economic Research, Dateline 2024 by these people. Daniel Greenwald, Martin Letow, and Sidney Ludvigsen. Two of them are from NYU, one's from Cal Berkeley. And they're so smart. They got PhDs and stuff. You know, Cal Berkeley and NYU. I'm not bashing these people. I just find, the appeal to authority. Well, they're from Cal Berkeley, and you're only from Kennesaw State. I'm not even from Kennesaw State. So what do you know? But anyway, let's go into this. Right there. How the wealth was won. Factor shares as market fundamentals. And I just want to kind of scroll down to the abstract right here. Why does the stock market rise and fall? From 1989 to 2017, the real, meaning net of inflation, per capita value of corporate equity rose at 7.2%, right, each year, from 1989 to 2017. Right? We estimate that 40% of this increase was attributable to a reallocation of rewards to shareholders in a decelerating economy, primarily at the expense of labor compensation. Economic growth only accounted for 25% of the increase, followed by lower risk price, i.e. a smaller equity risk premium. So a lot of people look at ERP, equity risk premium. What's the stock returns you get above bonds, all right? And they say, hey, as people kind of been made aware that stocks for the long run, and the longer you hold stocks, the less risky they are. It's just not true. But as they've been made aware of that, they're willing to buy up more shares of stocks, even as a higher price to earnings ratio, for instance. That makes sense. We have seen a pretty significant drop in ERP. And then on top of that, a lower interest rates. Interest rates gone down since 1982 pretty significantly. Interestingly, though, the period from 1952 to 1988 experienced only 1/3 as much growth in market equity, but economic growth accounted for more than 100% of that. So they're saying from 1952 to 1988, GDP was growing at 10% a year. It wasn't, but I'm just using that for example. And stocks are going at 9% a year. Now, I'm just making those numbers up, but you get it. They're saying the GDP more than led the equity market valuation growth. From 1989 to 2017, GDP was growing at 4% a year, and stocks are going at 8% a year. And again, I'm just making those numbers up, but you get what I'm saying. The stock returns weren't solely because of GDP in the last basically 30 years, not even close to it. It's very interesting, actually. A lot of people say, well, if GDP doesn't grow, the stocks can't. That's simply not true. Anyway, so it's interesting. We're going to come down here. While real corporate net added value grew at a robust of 3.8% per year from 1966 to 1988 amid anemic stock returns. All right, so we did not get great rates of return on our stocks from 1966 to 1988, and that's real net of inflation. It averaged much lower growth of only 2.6%. We were growing significantly less from 1989 to 2017, even though the stock market was giving us much higher rates of return. The multi-decade disconnect between growth in market equity and output, GDP essentially, presents a difficult challenge to theories in which economic growth is a key determinant to market returns. Interesting, isn't that? In this paper, let's see, we entertain an alternative hypothesis that GDP doesn't lead to stock market growth, but that cash flows have explained a larger share of variation in realized returns at low frequencies, but these movements have been driven by four-factor shares. And again, their factors are right here. They're going to say four factors. Economic growth only accounted for 25% of stock returns. 40% of stock returns was given to shareholders at the expense of labor compensation. And the other two factors would be low interest rates and low risk premium. And that's what gets me scared here because at the end of the day, are we going to get outstanding economic growth in the future? No, we're just not. An older, debt-heavy society is a deflationary society. Deflation is definitely not economic growth. Now, could we squeeze out 2% real? Probably. Not going to do any more. We're not going to get back to the days of 3 and 4% growth. Just not going to happen. Part two of this is how much can we squeeze out of labor compensation? I mean, at some point, you can't send every single person a job over to Malaysia or China or something, or India. You just can't. At some point, you have to retain some semblance of American employees. And as such, have we already squeezed that lemon so hard there's no more juice coming from it? That's my thing. I think you can say, hey, we're able to get by on lower growth and yet increasing stock returns because we're able to basically arbitrage. Essentially say we're going to get rid of a lot of these high-paying or higher-paying manufacturing jobs, things of that nature. But it's not just blue-collar jobs, a lot of white-collar jobs. And we're going to send that overseas, which is going to give us a higher profit base that we can use for shareholders and lower compensation. This is just a fact, dude. This just, I mean, I tell you, I've done a million videos on this. Median wages has grown by, what, 0.25% a year. Real median wages since 1979. 0.25% above inflation. That's it. Since 1979. With the American worker has been freaking just been stifled 100%, yet the shareholders have been freaking growing like weeds. It's not good, dude. It's not good. Part two of this, we're not going to have the lower interest rates, because remember the rates were you could have a 15 1/4 30-year Treasury bond in 1982. That guy just fell all the way down like 2% in 2020. Those days are gone. I mean, even if interest rates drop now, they're going to go at 4.5 to 3.5. I mean, at 2.5, I suppose, but that's not the same as before. So the days of low interest rates driving up stock returns. I mean, again, when you have low interest rates, you can borrow, you can leverage and all that stuff, and increase your return on investment. That's what it is. I mean, high leverage is ROI potentially. Yeah, it takes on more risk for sure, but the days when you can borrow low and freaking turn around and arbitrage and get high rates of return, are those days gone? I kind of think so. That doesn't mean it can't happen, but I don't think there's going to be a lot of anyone just shows up and borrow and put it into the stock market and make money. I think those days are gone. And I mean, there could be some still about that. Lower risk price. At some point, we'll see, but at some point the equity risk premium can't go down anymore. I mean, the equity risk premium, let's just say basically 4%. So 400 basis points. The stocks return 10, bonds return 6. Equity risk premium is 4%. Just use that for example. That can't go down to 6 and 6. That doesn't make any sense. No one's going to buy a stock at such a high price that it gives you the same future returns as a bond. No one's going to do that because a bond is a fixed, a stock is not. So no one's going to say, oh man, a stock market gives me the same risk as bonds. I will go ahead and invest at a high PE relative to the earnings of that stock because the equity risk premium is down. No one's going to do that. So anyway, let's keep going because I want to show you something. While the 1989 to 2017 period lagged the 1966 to 1988 period in terms of economic growth output, it exhibited growth in real after-tax profits of 5.1% a year that far outpaced the average of 1.4% of the previous years. Again, economic activity and output and GDP was dropping in the United States, and yet the after-tax profits for corporate America was going up significantly higher than the previous generation. And the reason for that, again, is low interest rates, lowering the equity risk premium, and offshoring. They don't say it explicitly, at least what I've read, about offshoring, but absolutely. And so stockholders have been made out like bandits. But that can't keep going on. At some point, you need some level of economic growth to support, if not sustain, your equity markets in terms of what you expect. 10% a year. Let's keep going. We find that neither economic growth, risk premium, nor risk-free interest rates has been the foremost driving force behind the market's sharp gains over the last several decades. Instead, the single most important contributor has been a string of factor shocks that reallocated the rewards of production without affecting the size of those rewards. Our estimates imply that these shocks increase profits to such an extent they account for 40% of the market's real per capita increase since 1989, i.e., shareholders getting richer, employees getting poorer. Decomposing the components of corporate earnings reveals that the vast majority of this increase in profit share was at the expense of labor compensation. And you have to be able to, it's just intuitive. It's intuitive. I go freaking ship my jobs to India or Poland or something like that, or Mexico, I'm paying less per job. Now the question is, are they doing as good a job? I don't know, but I'm paying less. I'm still producing the same product, which means my corporate profits are higher. Second, while equity values were boosted since 1989 by a persistent decline in the market price of risk, equity risk premium, and the risk-free rate, these factors play smaller roles, all right? Third, growth in the real value of corporate sector output contributed just 26% of the increase in equity values. By contrast, while economic growth accounted for more than 100% of the rise in equity values from 1952 to 1988, this 37-year period, only 1/3 of the growth in equity wealth generated relative to the last 29 years, from 1989 to 2017. Hey, puppy! Fourth, the considerable gains to holding equity over the post-war period can be large part attributable to the unpredictable sequence of shocks, largely the 4 shocks we just talked about. We estimate that 1 percentage points of the post-war average annual log return on equity is attributable to the sequence of favorable shocks rather than compensate for bearing risk. These results imply that the common practice of averaging data over the post-war sample to estimate an equity risk premium would overstate the true unconditional risk premium by 32%. Anyway, they're saying every single time frame is its own unique market result. And you can't say, oh, from 1950 to 2025, the market's averaged this. There's been all these different reasons why. So the question is, how are you going to get your growth? If it's not based on GDP, and the GDP is low, where's it going to come from? You're going to be able to get leverage? You're going to be able to offshore everybody? Where's the corporate growth or the equity going to come from? The growth, the rise in equity. I'm just telling you, you might want to think twice about, the stocks give us 12% a year going back to 1926. They did in the late 1800s, I'll tell you that right now. There's many times they just did not. We were just the only game in town in terms of, other than since the Reagan took over, it's just basically because we offshored all of our labor. And we saved the money that we could pay on labor costs and put in more equities. And we're able to take more risks and thus leverage and all that stuff. That can't go on forever, dudes. It just can't. So the question is, where does it come from next? And no one says that. It's all the averages. Okay, I get it. If you're going to say, the average, I get it. The question is, where does it come from next? I don't know. All right, love your thoughts. God bless. We'll see you. Don't forget to smash.